tonight. We want to talk about valuations, paper six. Paper six is really, you start in Excel, get everything in Excel, and then your paper is explaining what you did in Excel. So the requirement on paper six, so you want 3 valuation models with scenarios. So that's what we're after. Hopefully this will be a repeat of stuff you've seen before. I'll go through an example with Walmart and have an example video you can watch that essentially does papers 5 and 6. Maybe not with the scenarios, but so the 3 models I throw out there are given discount, the simplest of them, something I'll call capitalized earnings model, which is just my own. So don't use that term in the interview because they won't know what you're talking about. The H model. So those are the 3 that we'll talk about. For most of your firms, the H model is probably going to be your best model, the most powerful one. But we'll talk about how to do each one of these, and then the H model, especially trying to do multiple scenarios, can get a little tricky because you have so many inputs. So for all of these, you need your KE, which is the risk-free rate plus the market risk premium times beta. So you did that in paper 5, so you already have that. So what I'm recommending here is risk-free rate, just have one of them. Don't run scenarios on the risk-free rate. Market risk premium. Just have one of those. You did that in paper 5, so you'll have that. And then your beta, you want to have base, best, worst. Or data table. We'll talk about the data table. I used to show students how to do a data table. I'm now not a big fan of data table. I think you're better off just building it by hand, because it's just, to me, much easier to do by hand than to let Excel do it for you. But either way, so your base, if I'm doing Walmart, maybe on my base is 0.6, my best is maybe 0.45, my worst is 0.7. So your best case is the lowest. Your worst case is the highest beta. By best case, I mean the highest valuation, worst case, the lowest valuation, okay? You're gonna justify this in your paper 5. So when you do your beta discussion, is I'm recommending a beta, and you saw it, I think I showed you with Bond. He showed you the base, best, and worst in his last table. Probably gonna be somewhat influenced by the history. That's what most students do, use the history to get some sense of what the best and worst case could be. That's not bad to do, but have some rationale for it. You don't want your worst case to be 1.2 for a Walmart. So with Walmart, if I do 30, 40 years of history, their betas were pretty high when they started, but I know that's old history. So I'd probably cut that out of my analysis and focus more on more recent. Now, floor and decor, you have a firm that, I don't know how many years of data you have, but if you can't do the rolling beta, that's sometimes when you find a competitor and use their as a substitute. And you can do that if you just can't find a good. Yeah, 2012 is not bad. I mean, it's only 10 years, but I would, and the problem you have is finding a good competitor too, right? Because Home Depot and Lowe's aren't exactly ideal, but I might put their charts in there as just to show, or even best, as you talk about, put them all on the same chart so you can see, are they moving similarly? Your best case is you graph all of them, and Home Depot and Lowe's have all my history and yours have short history, but they're real similar in history you have. That gives you some confidence to use the longer history. But you need some basis for what your beta range is going to be. And then that gives you the KE, best basing. So you do all of this in Excel, and then you're just going to talk about it. So your base case is going to be risk-free rate plus your market risk premium times your base. So there's my range. How wide can your range be? Well, depends on the company. So to me, floor and the core is definitely above 1. Kind of depending on how much debt they have and those other factors that you're looking at. Would I go from like 1.2 to 2.5? I think that's way too wide. So I would probably keep it between maybe 1.2 and 1.5, but look at history and see what it's telling you. You are exposed to the housing market, which is a pretty systematic risk. Obviously, if you're exposed to mortgage rates, which is a systematic risk. So could you argue higher? Maybe, but I don't think I wouldn't go like 1 to 2.5. That's just way too wide. Walmart, I'm pretty narrow on the range just because I'm pretty confident what I believe about Walmart. It's definitely below 1, definitely well below 1. I don't like going below 0.5 much. I just think it's too low. I have historically used 0.7 for Walmart, but they've definitely proven themselves to be a really good risk reducing stock. They were the only positive stock in 2008. They did wonderful in 2020. So they've proven themselves. They really are a perform well in economic, especially recessions. They've been a recession proof company, but I still don't like going below 0.5. I don't like going above 2.5. I can't imagine any of your companies are going to be 2.5. So, I mean, take a Visa, like what who else is doing Visa? Forget, is that Alex? So, or can't remember. But on Visa, you might say, well, that's really tied to the economy. But with Visa, you buy groceries, you also go to movie, it's a mix of stuff that you buy on your credit card. So it's going to be kind of a mix of high and low beta transactions. So not necessarily systematic. I don't know how much interest rates influence the use of credit cards, if people are worried about higher interest rate charges. So you're going to go through that, get your scenarios. But you can see with Walmart, my range is not particularly wide for them, which is fine. You don't want to get too crazy on this. The other thing, remember, is must be greater than long-term growth. Don't forget that your best case must be greater than your long-term growth. Well, see in the table, it's possible in your table that you will get a few scenarios where the discount rate goes below your growth rate, and we'll just black those out. We won't even show them. So this you're going to use with all the scenarios. So you don't need different assumptions. So your discount rate is going to be the same. For all three, so that you don't necessarily have to do it like I did there, but the next thing you need is growth. So you have long-term growth, short-term growth, the H, the half-life, and inflation. So on these, where do you run scenarios? We're going to talk about in this where you can do it. So definitely on dividend discount model, you're going to have a best case and worst case. So this is where you're going to go back and look at the history, look at the assumptions in your paper 4. You're going to bring it all together. What's the best case for Walmart? So, or the base case for Walmart. So the long term, once Walmart saturates everywhere they can go, it's essentially population growth and inflation. Am I going to give them some credit for the fact that they're a well-managed firm? They're going to find ways to be more productive. those kind of things that can add some growth. So my base case is going to be 4.5%. You might not agree with that. If you look historically, they've had a tough time getting that. But I know Wall Street tends to be in that 5% case. My best case is probably gonna be 5, and then my worst case is gonna be 3%. My 3% is gonna be population plus inflation, population growth plus inflation, because I think ultimately that's every retailer. And the reason I argue that is even they become more productive, they find ways to use AI or robotics. So is everybody else, and that's just going to drive the competition, drive prices down. So they're actually not going to get the benefit from those things. Hopefully, the consumer benefits from that. But the key is you're who knows if that's right or wrong, but the key is that you're explaining that. So your best case is your highest growth, your worst case is your lowest growth. My best case is 5%. My lowest KE is 6.6, so I'm in pretty good shape there, right? On inflation, that applies to the, let me put some titles in here. So inflation applies to the capitalized earnings model. I'll give you that formula here pretty soon. So base case, I'm going to go with 2%. Best case here, this is a little bit tricky. And the reason it's a little bit tricky is inflation influenced your market risk premium. I'm going to let you know just so you can ignore that for this particular case. We are talking about general inflation, but it really should be inflation related to Walmart, how much of their that could you pass on. So I'm not going to go very wild here. 3, so higher inflation is going to let them raise their prices more. And in worst case, maybe 1%. So I'm not going to go, well, even that's too low, 1.5%. Actually, I'll probably do 2.5 and 2 or something like that. So capitalized earnings, when I explain it, you're going to see that it doesn't matter as much on that model because of what it's telling us. It's not actually telling us valuation, it's telling us the floor for the stock. So it's a little bit different. Then on the H model. On the H model, you can use the same scenarios here. I'm going to talk about why you might not. And then short-term growth, same thing. So for Walmart, I have no idea. Let me just say 8%. Best case, maybe 10%. Worst case, and it may be 1%. So I'm going to get pretty wild on this because 8% is still coming out of COVID. There's still a lot of money in checking accounts. Walmart's doing some, their online is really improving quite dramatically. They're doing a lot of order online and come by and pick it up. That seems to be working really well. They're still growing overseas pretty aggressively. They bought the firm in India that's starting to show some promise. Jet.com is giving them a lot of advantage, those kind of arguments that, they haven't grown all that fast, but they're starting to, I think actually for Walmart, my biggest argument is Amazon starting to show some cracks in its a business model and they're struggling. Best case, that's probably a little too aggressive. Worst case is, it's just none of the stuff they're spending money on really comes to fruition. They just don't see it. So. And then the half-life, I'll show you how you might be able to use multiple scenarios, but it's going to be a little tough. I'm not going to use too much here on them. I'm going to maybe say 3 years. So we've got our assumptions in there. So you can organize it how you want to. I'm putting in Excel like this. You don't have to necessarily do it this way. And then you need dividends 0. You need earnings per share 0. So how do you get dividend 0? Kind of depends on your company. So the base case you can do is just go to historical data and change it from historical prices to dividends only. I would do the max, hit apply. So you say dividends only. It doesn't matter if you do daily or not because they're only going to show when they pay dividends. So you can leave it on daily, go back to the max, then apply. And so dividend zero is the last 12 months of dividends. All right, 57, 57, 57, 56. So for them, that's $2.27. Use that for the dividend discount model and for the H model. Uh-huh. Yeah, we'll talk about, I'll show you the substitute for that. Well, let me do it now. It's not a bad time. So if you don't have dividend zero, you can use free cash flow zero. All right. So how do we do that? Let me show you how I do that. One approach, you can just go to Bloomberg and get their number. The other approach, and we're gonna have to talk about normalizing. So the way I like to do it is do cash from operations minus CapEx divided by number of shares. All right, real simple. I keep it real simple. And I don't think that's that much different what Bloomberg's doing. They may be doing the formula y'all saw in Catapacums, with the operating income, you adjust for tax and all that kind of stuff. But I have no trouble using CFO. CFO is already net of tax. So CFO minus CapEx. So if we're looking at a Chipotle that I can never remember, there it is, CMG. So you go to financials. No, actually go to statistics. No, go to financials. Excuse me. Go to financials. Cash flow statement. Their operating cash flow. Wow. They really jumped that much. Is this 2020 really? Wow. I thought they did well in 2020. They actually cut back that much? Oh, I don't remember that. Really? Wow. So what is this? Did they buy somebody? That's pretty amazing. Wow. All right, so I'm going to bring these in. I don't know if this will work or not. We'll see. Yeah, I guess that's okay. All right, so this is CMG, CFO, CMG, X. That's under investing activity. Is essentially, they call it purchase and sell of PP&E, but it won't let me over there. I don't know why it won't let me over there. Very strange. Does it line up? Yeah, it lines up. All right, so that gives you free cash flow. And you have shares out. That you can use to get on the income statement. Basic average shares, diluted, let's do the diluted. They don't have them. We'll copy it over for the current month and current year. And that gives you free cash flow per share. Now, it's so radically all over the place. So do you normalize that somehow? So that's the other issue. So if I were doing Costco with those massive dividends they do, I might add 5 years together and average and use the average of the 5 years, given they do that massive dividend. If a firm that's not paying dividends, then bring in their cash flow, free cash flow per share, and look at it over time, just to make sure you're not in an unusual period. Now, Dante, I don't trust the most inside column. They're doing something strange in Yahoo Finance that's a little bizarre, so I might not use that one. But you can see the last couple of years, it's been about 30 bucks. That's pretty strong, right? If you use the 10 bucks, that's pretty weak. So do you go with 30 bucks? Possibly. Again, you might double check it with Bloomberg. I mean, yeah, with Bloomberg just to see. Questions on that? That's a real simple, quick way to get a free cash flow per share. Now that gives them a free cash flow per share higher than their earnings slightly, not dramatically, but that is possible. Firms can have. Why? Because you got depreciation and other things that are in the earnings per share that aren't part of free cash flow. So it is possible. So then you just got to pick a number. So it's not earnings per share, it's not dividends per share, it's a normalized number. So if your most recent number is really unusual, you maybe need to do some type of an adjustment. Remember, we said the same thing on your growth rates, your kind of sustainable growth. Use a few years worth of data so you make sure you're not being affected. So what's the theory on these models? The theories on the dividend discount model is firms pay out their free cash flow as dividends. But if Walmart's not paying their free cash flow out in dividends, then that's not a good number. So let's try the same thing here with Walmart and see how radically different it is. We'll get their CFO. Nice thing is you can get it all in one place. I think I'm gonna go which column it in. I'm in 37. I don't want. Okay. You see, you got a much larger number now. It's kind of all over the place. $4 versus 227. I don't think Walmart comes close to paying their free cash flow in dividends. One reason I say that is their dividends have increased a penny every year for the last 10 years. 1 penny. That's a pretty round number, and it's just been going up a penny. So that means the growth rate in dividends is coming down because every year they're doing 4 cents a year or 1%, 1 penny a quarter. So it's possible for your free cash flow to be much, much, much higher than your dividends. For a lot of companies, obviously, we don't pay dividends. I imagine Ford Decor doesn't pay dividends. Now, what do you do if they don't pay dividends and their free cash flow per share is a negative number? Yeah, you kind of have a problem. So you have to come talk to me if that's the case. If anyone has a problem, come talk to me and we'll have to figure it out. Because then the only choice you have is to forecast into the future and use a future number. You have to somehow figure out when they go from negative free cash flow to positive free cash flow. There are firms that do have negative free cash flow. In fact, Netflix was a good example of a firm that had negative free cash flow while we're doing all that production. It's pretty significant. All right. So do I use 227 or something else? You just got to justify what you're using. I'm going to stick with the 227 because it gives me a pretty high stock price anyway. So we'll see. Maybe I could go to $4. These are more normal times. Who knows? All right. Any questions on free cash flow as a substitute? Whatever you use for the dividend discount model, you also can use for the H model. So you don't have to. You don't use like dividends for one and free cash flow for the other. Be consistent. Then for the capitalized earnings model, this is where we use earnings per share. But again, on earnings per share, you want to think normalizing. So use the diluted earnings per share. Been pretty consistent. 427 has been the lowest. The 519 is probably COVID induced, so that's probably too much. The 427 looks a little low. I might use 480, which is somewhat, or 460, that's the average. So as long as you justify what you're doing, you have some basis for it, it's fine. You don't have to use an actual historical number because the numbers are fluctuating around. So I use 460 there. If your firm has losses, then again, you're going to have to normalize. If the last year was a loss, you have to figure out. I don't think any of your firms have losses recently, so you'd probably be okay. All right. So here's my valuation. So dividend discount model. Anybody remember the formula? This is kind of a basic formula. Long-term growth. Right. Yeah, just your standard kind of perpetual growth. So for some reason, they call it the Gordon growth model. I've never understood that because I don't know who this Gordon guy was to get credit for such a basic formula. So it seems like a little overkill. I should look up and see who Gordon is, but and I can't imagine he's the first to use it either. So I don't know what year he was born. I should look up Gordon. But anyway, so there's the formula. So for the base case, 227 times 1 plus base case growth rate divided by KE minus base case. Here's my value. Now, much lower than the current price of 163. This is when you're going to cheat. All right. It's like, wow, that gives me a really low price. And I always get low prices. You know what? I'm going to use my dividends, my free cash flow per share. Now get 171. Now, why do you do that? Most students, when they get a price of 70 bucks when the stock's trading for 150, the first question they ask is, what did I do wrong? Isn't that correct? What did I do wrong? And why do you ask that question? Because obviously I can't be just uncovering this grossly mispriced price. So that shouldn't be your first question. Your first question is, where do I most disagree with the market? So I do think with Walmart, their dividends are maybe not the best approach for free cash flow, but this is why I say you do the Excel first before you write your paper. You know, don't justify, oh, 227, that's what I'm using. And you go to evaluation, you get valuations you don't like. So if I use 443, I get more reasonable numbers. Let's see what it works though when we do the other ones. So I'm going to lock in the dividend. I'm going to lock in, well, I'm not going to lock in those other things. So I should be able to just copy it down. So that gives me a range from 99 to 290. Now, is that reasonable? So the CFA, I really need to bring y'all the CFA example. It's really old, it's ancient, but they had 130 something scenarios. And I think it ranged from like $25 to $150. Really, really wide range. There are people in the business that strongly disagree with that. They say, how can you go out with that wide of a range? I personally believe the range is truly that wide, that we're that uncertain about the value of a stock, because none of my assumptions seems particularly unreasonable. So you might get a pretty wide range. What you don't want to do is something like that. That's when you're going to go in and say, okay, there's something wrong with my assumptions. Right? It's worth somewhere between 50 cents and 1,500. Are there stocks like that? Yeah. In my previous class, we are talking about the weight loss drug. Yeah, it's either worth nothing or worth billions and billions of dollars. Yeah, they have that kind of range. But so this is actually pretty reasonable. So don't freak out if your range is a couple $100. It can be pretty wide. If I were doing alphabet right now, my range would be really, really, really wide. Right. Questions on the dividend growth model? Pretty straightforward model, 3 scenarios. All right, let's now talk about the data table. Have y'all done data tables before in here? Let me show you how Bill Gates does it. So, um, now to do it, you have to put each individual piece in there. My risk-free rate is that, market risk premium is that, and my beta, base case beta, is 0.6. My long-term growth, 4.5. All right, and so dividend discount model, valuation, do it again. Risk-free rate plus market risk premium times beta minus long-term growth, 171.28. 29. Right, so what I'm going to do is I'm going to have different growth rates in different betas. Boy, I don't know where to put it here. Growth is going to come down here. Betas can go there. All right, so I'm going to start my growth at, say, 3%. Ah, Bill Gates, I need your help. Now I'll go up to 6. And my beta, I'll start at, all right, on your beta, on your growth rate, start the lowest, on your beta, start your highest. So what you have to do is you have to get this formula right up in this corner. And what you're going to do, so who's done a data table? Dante, you're the only one. Alex, anybody else? No? All right. So what you do is you fill it in, you column in. So then you do data, what if analysis, data table. So data, what if analysis, data table. And my row cell is beta. My column is growth. And then it will fill it all in for you. Pretty wide ranges, right? All right. So a few things I'm going to do here. And any questions up to there? So that's a data table. So you don't have to do a data table. You can do it by hand by just putting a formula in there. It's actually pretty simple just by locking in things and copying around. But Bill Gates does it all for you in kind of a simple way. Right. So what you want, these are pretty popular in previous papers. So just so you see how they did them. You can certainly fancy it up. I like to hide this so it doesn't show up. Just remember that it's there because if you delete it, it's going to mess everything up. So there's a few things I want because I don't want to show my boss that I think Walmart's worth $1,200. All right, that's just a little too crazy. At least I didn't go negative, right? So none of my discount rates were lower than my growth rate. I didn't go negative, but that's getting a little crazy. So I'm going to put the current price here. My current price 163.25. So what I'm going to do is going to highlight all this. I'm going to do conditional formatting right here. Highlight cells greater than. So if they're greater than that, so if my valuation is greater than that, is that good or bad? Do I like Walmart or not like Walmart? You like it, so that's going to be green. So there's my good scenarios, and then I'm going to do conditional formatting. It's less than that, you red. All right. And then one last one. This is just me because I've had bosses like I tell them, well, ignore the corners, they're not important. They can't. That's the whole. I have a 2-hour discussion. Why do you think it's $1,200? It's like I don't. That's just the way the math came out. So, what would be something you think your boss would just freak out on? So, I'm going to go anything over $500. I just don't want him to show it. Right? You can decide what you're going to do. So, now this gets a little bit tricky. We'll see if it works. Sometimes you cancel the previous one. Let's see if I can get this to work. So here, what I want to do, I want the fill to be black. Did it work? Yeah, it looked like it. Oh, I got to change. So close. It's greater than that. Custom. So I want the fill to be black and I want the font to be black. That work? There we go. All right, that's how you get yourself out of those massive numbers. So if you have a negative number, you want to get rid of that as well. So if it's less than 0, just black it out. That way it doesn't show up there. All right. Now, the big numbers, you can leave those in, but the negative numbers, absolutely you have to take those out. Don't show a negative number in your chart because it's not negative. Remember, it's not negative, it's infinity. You're saying it's worth infinity, so you don't want to show that. The last thing you're going to do is, I think my base case is 171. So my growth rates are between 4 and 5. My betas are between, say, maybe 50 and 70. I can't see all of those. So I might highlight this section in here. And you'll see a lot of charts like this in the papers, okay? You can definitely clean it up quite a bit. Oops, and you have to change that one too. You know, so what do you have to do to make it look good before you put it in your paper? But that's what you're looking for. Now, does Walmart look overpriced or underpriced? And that's what you're trying to figure out. Now, if I go back and use the dividend, where did my dividend go? Wow. Oh, then it doesn't look so good. Looks like a materially overpriced stock. Try to get it so that what you're highlighting is somewhat in the middle. I kind of went too far over. Make sure all your columns are the right width and all that kind of stuff. But it doesn't take that long to get some pretty good analysis. So that's a data table. They're not as popular as the football chart I was talking about last class, but they're pretty powerful, pretty effective. Questions on that? That's a dividend discount model, which is pretty easy to do because you only have really two things that you're changing. Let me save this. I can even put this file out there on Canvas as well. I do warn you in an interview, not everybody likes this approach, but it's very consistent with the CFA Institute does. So it's not, you're not too radical. Had one portfolio manager at the Sector Wars just say, yeah, that's way too wide of a range. But we're talking about forecasting Walmart over the next 500, 600 years. I think that's a pretty tough thing to do. Probably over half their valuation is out at least 80 years, beyond 80 years. I mean, we're doing something really, really tough. I don't even know if Walmart will exist in 50 years. I'm hoping they don't. I hope they go out of business because someone better comes along, has a better product, better process. So I'm actually hoping they go out of business, but you know, we're forecasting out a really, really long distance. So, all right. Now the H model, similar type of thing. But the H model formula, you remember that one, Dante? That's a little bit, you start with the same formula, right? And you're just going to add something to it. So you start with the dividend discount model. Do you remember that section we had? Well, what comes before the H? Close. Yeah, so we're gonna add a little section to show, hey, this firm, long term, it's gonna be growing just normally, but right now it's an unusual growth period. So we're gonna take dividend zero times the H is the half-life. So if it takes you 10 years to get from the short-term growth to the long-term growth, your H is 5, right? So you do have to justify the H in your paper, which is where most students lose some points because they don't do a good job justifying that. So have some basis for it. Pull it from paper 2, from your forecast, whatever you have. There's something every firm's doing that's interesting. It can be negative on the floor and decor. You want to say, hey, mortgage rates are high. They're going to be really stretched for the next 3 or 4 years, but eventually the housing market will come back. The problem you're going to have, though, you can't go negative 3 years and then positive. It doesn't let you do that. You just got to start. You got to go to a level. So it's not perfect. If you want to do like negative growth for 5 years, but then a big comeback later, you're gonna have to just do that line by line in Excel and value each piece. All right. So if we do that, the nice thing about this is that we can, oh, this is the H model. The nice thing about that is you've already got the formula set up here. So we're going to do B34. So I guess it's going to be G34, G31, G15, G21, 87, 86. So something didn't work out there. Oh, I got to do the middle. So that works, right? So now I got to do the middle part. So you start with the dividend discount model, and then we say plus dividend zero, which is G34, times my H. Where are my H's? I'm going to just use 3 for that. Times short-term growth minus long-term growth. It should be everything. So is it correct? So I would double check, make sure you have it correct. So the difference is $8.33. That difference should be that middle little part of the formula. Should just be dividend zero times 8 times short term. So we can try that. Dividend zero. I don't know where it is. There it is. Times short-term growth minus long-term growth divided by KE minus short-term growth. And did something wrong, or I've got, no, that looks right. So there's something wrong with my formula. G34, G25 minus G21, that looks good. Divided by G15, looks right. Minus G, everything looks right. So I don't know why I've got a different numbers unless I did something wrong here. Not seeing anything. Anybody see my error? So somewhere I messed up. G21, G21, 34, 34, G34. That's the same. I didn't switch it. No one sees my error. G15, G30, 21, 34, 28. Ah, there's my problem. I forgot to multiply by G28. Does that get us closer? I forgot to multiply by the H. All right, so 883, so I know it's correct. I should be able to copy this down and get a whole new range. So there's your H model of 3 scenarios. I'm not going to show you how to do the scenarios on H tonight. I may wait to Thursday to do that because it gets a little complicated. Because we have so many things. We have long-term growth, short-term growth, the H, the beta. You have so many different things going on that it gets a little complicated to set up. For Walmart, it doesn't make much of a difference because my H is pretty short and my long-term growth isn't that radical. So it doesn't make a huge difference, but it does give me a few more valuations. So, and I'll just warn you, the way I do the model here is I essentially produce everything except for beta in columns. So I have different long-term, short-term, and it gets messy because you want to do it in a way so that the values go in order. And so it's like 6 different things combined in one number, so you can come up with a scenario. But it's a little messy. It may not even be worth to do it because it's so messy. It's hard to explain. Okay, capitalized earnings model. Let me just walk you through the scenario there. So this is my own idea. It's essentially saying, what's the value of the firm as is? No new growth, no expansion, just what's the value of this firm if they do nothing new? And so if that's the case, they just pay out all of their earnings as dividends. So their earnings per share is their dividend. And that's going to restrict their growth. I'm going to say it's not going to restrict your growth to 0, even though the sustainable growth model says that. If your payout ratio is 100%, your retention 0, then your growth should be 0. I'm going to say they should be able to keep up with inflation. They can raise their prices with inflation, their costs go up with inflation, their earnings will go up with inflation. They have some depreciation, lets them do some minimal refurbishing as they need with buildings and things, but they should be able to have some decent ongoing operations with that. So the capitalized earnings model looks a lot like the dividend discount model, except instead of using dividends, we use earnings per share. And instead of using growth, you use inflation. Now, this is my own idea, and I was thinking no one else knows about this. But then I watched Katapakam, I'm not Katapakam, the Mordaran actually talking about this model. I don't know who gave it to him, but someone gave him this idea, and he talked about how stupid of an idea it was. So he didn't like it. But he didn't get it from me. I didn't send it to him. One of the things he said was if your revenues grow by inflation and your costs grow by inflation, your earnings don't grow, but that's not true. You can do the math. If your revenue grows 2%, your costs grow 2%, your earnings also grow 2%. It's not 0. So he was thinking off the top of his head and just had the math wrong. I don't view it as a valuation tool. I view it as a floor. What's the minimum value of this firm? And so we'll do that scenario. So earnings per share is 0. Did I bring in earnings per share? Yep, there it is. Times 1 plus inflation. I'll take that off the video, maybe. It should be obvious in the audio. I'll see these splashes. Times discount rate minus that. So that we lock in. There's my valuation. You notice on the worst case, it actually gives you a higher value. You will sometimes see a higher value on these firms. And that's because my worst case, the growth rate is so weak, it's lower than inflation, and obviously they're going to be worth less. Now, what do I do with a number like this? What I like with this type of number is, first of all, if a firm is trading below it, I find that pretty impressive. I'm going to go back to my free cash flow per share. Give me better valuations. So there you can see because free cash flow is higher than their earnings, barely, I think. Their earnings were, where are their earnings? Earnings per share. Did I put earnings? Oh, I used free cash. Oh, I think I just typed it in the wrong spot. Or maybe not. Did I? Yeah, I don't think I ever got it. So what is their earnings per share? So if you go to the summary, it'll show you their earnings per share last 12 months, 521. So I just never typed it in, 521. So it's much lower than my other valuation, but if Walmart were to stop building new stores, stop expanding overseas, stop doing anything, just sticking to what they're doing, this would be what their value is. I found this very valuable if you do several companies. So y'all aren't doing that. But the reason I like this is I want to know how much of Alphabet's value is current operations versus what they're going to be doing in the future. I like to compare this between companies. So by itself, it kind of gives you a floor. You may talk about it as a floor valuation. I have seen, when in 2008, Apple actually was trading below this value, and that was pretty impressive to me that Apple was really, really cheap, thinking Apple's not going to do anything new ever again. So it gives you a value, kind of the minimum value, the lowest you can have. This is one I might not do a data table on because I think it might be a little overkill. So you might just do it and say, one analysis that we do is just curiosity. What's the value of this firm as is without anything new happening to it? And here's the value. You could compare that to a Costco or to a Kohl's and say, is the market expecting more out of Walmart in the future than they are out of Kohl's or Target or Costco? So that's where I think it can have some value. It's a really easy model to run. So you could run it against 3 or 4 different companies pretty quickly just to see what that kind of difference is between the valuation and the floor. All right, questions on those are the 3 models. So you either use dividends or use free cash flow per share. Every firm better have positive numbers. If you don't have positive numbers, then we're gonna have to figure that out. All right. I'll put this out there on Canvas. All right. Now what do you do with that? So in the past, and it may be in the rubric, I should look and see. Paper 5 is really straightforward. So paper 6, justify your growth rates and valuations. I used to say, and you may notice this in some of the papers, to do a summary of all your valuations. But I'm going to save that for the end of page 7. Paper 7, you're going to bring everything you've done into one place and talk about the firm overall. And that's where the football chart's going to come in. All right. So it got a little awkward in the past. People do it in paper 6, and in paper 7, they have more valuations. And so now what do I do? So it's ridiculous to have it in 2 places. So both 6 and 7 are valuation tools. We're going to bring it all together. So essentially what your football chart is probably going to bring in is the dividend discount model, H model. It might or might not do the cap earnings. And then you're going to do a relative value. So you're going to have those 4. Then you might show the 52-week range and the current price. That's probably going to be your football chart. The one other model we'll talk about, and I can't get Capital IQ to work on my laptop. I got to get it to work. I want to show you, I do want one more model. It goes in this. You can use the one I'll show y'all that I have already built, but I don't like it that much. I'm doing it because they forced me to put it into because it's just kind of a standard. But one more model, but here what I actually recommend that you do is you find one in Bloomberg or Capital IQ, which is going to be pretty easy because you're just going to bring in the model, put in your ticker, change your assumptions, and it will do all the work for you. So I just want you to be able to say in an interview, yeah, you go out and you find other people's models. So I'll find one. I don't know how I'm going to do it with Cap IQ. I may have to do it on Cap IQ and Bloomberg and freeze everything and then show it to you in here. But Cap IQ has some pretty powerful models. I think they have a section, if you look in their templates, that's even called valuation. When you click on that, there's just a bunch of models. So it's just finding one. I'll try to look at a few of them to see if there's some that really stand out. They're going to be pretty standard type of, pretty common type of models that you see in investment banking and other places. So that's going to be your football chart. And what you're trying to do is look at these ranges versus where they have traded and where they're currently traded. And you're trying to see, is your stock trading to the rich end or to the cheap end of these ranges. So you see where we're going. So this is paper 7. This is paper 6. So you see, we're getting close to the end. Y'all thought this class was overwhelming. We're getting pretty close to the end. We're not that far away. These last few papers is a lot of Excel work, which y'all probably prefer anyway, right? Y'all prefer to be clicking in Excel than writing papers. So you're kind of in your comfort zone. All right. The last thing to talk about is model building. So the question can be is, do we work on paper 7 next week? Are you going to be too distracted with 5, 6, 4, 5, 3, no, 5 and 6? Are 2, 3, and 4 due this week? So you get those out of the week.
You change this to during 2 and 3 and then 4.
Well, you can, yeah. I mean, if you can get them out of the way, you can. So I forget what the syllabus said. We have a little bit more on paper 6 to talk about. So we'll finish that up. So we're supposed to, so I have a little bit of a lecture on relative values to go through what it means. So I do want to break up into groups. So really what I want to do is have a few on Monday that we can test and see how long it takes. If there's a few that could come like a Monday at 5 or 6 or 7 or something, 5 would be better. And then if that can work in 40 minutes, then we can do Tuesday, 2 groups. So are there anyone in here that could actually come on a Monday and then you get to skip to Tuesday if y'all can do so? Maybe I'll email this weekend. Should we try it next week or should we try it the week after next? Week after next. So next week we might have a topic where we talk about bond markets for a while. So we'll try this. What is that? November 5th or something? November 6th. Now what we got to do on the 2 groups is the first group shows up at like 7:20 and goes to 8, and the second group shows up at 8 and goes to 8:40. But the second group, if we have to go a little over, you can handle that. I'm already giving you 40 minutes anyway, so we might have to go to 9. Would that work, everybody? Y'all don't have a 9 o'clock class, do you? Anybody? You don't have to be at work at 9. So if someone has a conflict at 9, you need to be in the first group. So how many people we have here? Did I see that right? Who else was it? Claudia, did you raise your hand? Oops, well, I just read. Who else said they could? Derek? Anybody else? The others? All right. It's 1, 2, 3, 4, 5, 6. That would leave us 9 and 9. So I still have to count the number of machines that are working in there. I think we have 9 in there that are working because there's 3 on the back row, 3. We have the teacher station I'll be using. So 9, so that works about right. So we'll see. One thing that would really help is if you don't have a Bloomberg account, get a Bloomberg account before that so that you can just go in there and start moving. All right. I think we can do it in 40 minutes. I don't think it would take that long. If it gets desperate that it takes too long on Monday, then we'll do it Tuesday and Thursday and do something. I hate to give an extra walk, but all right. So y'all see the plan going forward. You should be able to build your entire model in that session. So all you have to do is write about it. So it becomes really simple. And some of y'all have done these before. I have videos that show you how to do it. So if you want to do it yourself and figure it out, you can do that as well. And if you want to do that and send me your model, then you can skip the whole thing and just do it yourself. So if you go to my website, I have a Bloomberg channel as part of my channels. And there's one in particular, the aerospace, that walks you through it pretty well. So you could do it yourself. You could teach yourself how to do it. So you don't actually have to have me. So that works as well. All right. We'll stop it there. I'm adding this to the beginning of our class on October 26th because I forgot to turn the Zoom on. So the one thing I covered at the beginning of class that I'll do again in this video is I wanted to show a way to do a data table for the H models. So what I did is I brought in the numerator for the H model, and I'll show you that numerator here. So I have the free cash flow, the H, short-term growth, long-term growth, and then the numerator. Short-term growth, I went from 0% all the way up to 10. Long-term went from 2% up to 6. I could have varied the H, but I didn't. I think if I were to do this again, I might have had just 4 short-term growths and just 3 long-term growths, so I wouldn't have so many versions, and then maybe done a few H's. But just showing you how you can do it. And then what I did is I did the formula for the numerator, which is, if you remember, is the cash flow, whether you're using free cash flow or the dividend, times 1 plus the long-term growth plus the cash flow times the H times short-term growth minus long-term. And that gives me my cash flows. I copy those down. And then the next one, I'm not actually using a data table that I showed you. Instead, I'm doing a formula. So the formula is the numerator, which is that 394 we just did, divided by the discount rate minus the growth rate. You see how to lock the column in on the numerator, had to lock the row in on the discount rate, and lock the column in on the growth rate. So what I'm going to do is I'm going to sort this, but you notice when I do the data table, I've got reds and greens all mixed together. And so what I want to do is I want to resort this, but I want to sort it by column L, smallest to largest. And in doing that, I have a much better looking table. I have a few you'll notice that are a little out of order and haven't quite figured out the math behind why you have a couple of them. It's just we have so many factors going on here. But when you do this, you do get a fairly decent looking data table, even though it's not technically a data table because we built it ourselves. And so I have several factors, and again, I don't think it makes sense to vary the free cash flow, but it certainly could make sense to vary other things. I've got the beta in there, and I've got the entire formula. So you can do a more sophisticated data table with something as complex as the H model, but you have to set it up like this, and then sorting it so that you get everything in the right order certainly works. I don't know if I sorted back on column S, if that would fix things. I can try it real quickly and just see. Column S is the 7.1%. Let's see if that fixes anything. That actually did fix it. So yeah, if you see one out of order, then just sort on that column. It seemed to work. It may not work perfectly. You may end up with one that's kind of out there all by itself in the green, but that's the way you can use the H model to, I mean, you can use the data table to expand out your scenarios on the H model. All right, so now let's talk about this model. All right, so Kaylin, I'm showing them a model I got off of Kappa IQ. And I was just mentioning they have something called language in there that I actually got rid of when I did the values that you don't need to. The language works. So you just have to get rid of all the Kappa IQ references if you want to use them, use this at home. So this is a pretty good model, but they have assumptions. So under the assumption side, I would use the current 10-year treasury. So I'm just going to key that in over it.
There's a drop down where you can change from the 1 month to the 10 years.
Yeah, I think it's tied to Kappa IQ though.
Oh,
So I can't. So yeah, so I mean, that's a good point Juan Carlos is making. If you are here with a Kappa IQ, there are places you can make those changes. So yeah, be real careful on that. Yeah, I should have brought that up. So like in some of these other things you can change. So since I copied and pasted them as values, I can't do that. S&P market return last 10 years, I'm not going to use that. So that's not the market. That is not their market risk premium. That is the actual stock market return. So if the 10-year, so I'm going to simply say, okay, my market risk premium is 4%. So I'm just going to add 4% to my risk-free rate. There is no size prism. We talk about floor and decor. Maybe you add 1% for the size premium, but they have that set up there for you. All right. You can, if you have a company under say $10 billion or so, especially if your firm's not in the S&P 500 and it's smaller, you might add a size premium. You can Google the Moitheran for the size premium, and he'll give you a number that you can just plug in. It's usually 1% or around that level. So they have debt, debt to equity. There's some other numbers. Those are just pulling. So why are they asking for debt? So this is the thing. I was supposed to teach all that. I don't want to teach all, so that's why I'm saying I'm letting you get away with this. So if they're asking for cost of debt, what are they trying to do? They're trying to figure out the weighted average cost of capital of the firm. To do what? So what model are they doing? So they're doing a free cash flow model, but the way they're doing the free cash flow model, you've probably seen this. If you've had Catapacum, you did this in his class. And it's a very much an investment bank approach. So you get the free cash flow of firm. You get the cost of capital of the firm, which is the WACC. Anybody remember the formula for WACC? Go ahead.
Weighted debt times cost of debt times 1 minus tax plus weighted common equity times cost of common equity.
Yeah, plus others. So I ignore the others, preferred stock, those kind of things. You can ignore that. So like Dante, I don't know what they're going to do with your capital leases. Maybe they'll put them in there, maybe they won't. I don't know. So capital leases, preferred stock, there's other things. This spreadsheet's going to have whatever standard. So that's kind of a nice thing about it is this Standard & Poor's that's doing this. It's not going to be some high school seniors project. This is going to be a sophisticated model. So that's going to be in there. The weighted debt and the cost of debt are supposed to be market valued, but that's really hard to do. But the interesting thing about Cap IQ is they're pulling in all the firm's debt. So they could do some fairly sophisticated stuff with this. But if you have capital leases, it's really hard to get the market value of capital leases. So a lot of times people will just do book value of debt because it's just so hard to get everything else. But who knows what they're going to adjust in this particular model. Once you do that, you do a discount model. Essentially, free cash flow times 1 plus growth. But here, you're gonna divide it not by the KE. You're gonna divide it by the WACC minus growth. And what is that gonna equal? You remember that? That's the value of what? Of the firm, value of the firm. And so then the value of the stock is going to equal value of the firm minus debt. That is a very standard model you see in investment banking. I rarely saw this model on the buy side. You see it in Catapacum's class. It's very much things you see a lot in academia, because academia really loves free cash flow, the value of the firm minus the value of the debt. And that's one of the things they changed at the title of this course is not value in stocks. It's not security valuation or security analysis. It's corporate valuation. It's the value of a firm. So I've shown it to you if anyone asks, so it's there. We're doing it. So the reason I like this spreadsheet is that's the approach that it's using. And that's why you need this. But the nice thing is it solves a lot of problems for you because it pulls that data for you. You don't have to spend a lot of time coming up with the WACC of your firm. All right. They don't have any preferred stocks, so that's kind of nice. You can take that out. Risk-free rate, United States. Oh, there's the drop down you were talking about. I can't change that, but so if you're on Capital IQ, you can use these drop downs. All of you are doing U.S. companies, so that's the one drop down you might change. Corporate yield curve, you probably would just stick with what they have. So the market risk premium, there's that 4%. Remember, I took the 10-year plus 4%. So they got that right number there. Beta, there's their beta. So what can you do there? You can type in your own beta if you like to. So Z24. Z24 is bottom-up beta. And there's regression beta. If you don't want to use their beta, you can just plug in your own beta. Okay, so you can completely ignore that. Y'all know what bottom-up beta is? I don't know if we talked about that. I'm not a big believer in bottom beta because it's just too much. Anybody remember bottom-up beta? Have y'all have Catapacum in here? Did he do bottom-up beta? Yeah, the regression. So he didn't do one of these. So bottom-up beta is essentially the beta for each segment. So you have to determine the beta for each segment. Beta of firm is the weighted average beta segments. So you're just bottom up building the beta. So if you do Disney, you've got movie producer, theme park, you've got cruise line, you got some TV, online, you got digital, you got all these different businesses. You take those segments and assign a beta to each one of them. And the way you do that is you find a competitor that only does that one thing, which is pretty tough. I mean, you could take Six Flags, right? Get their beta adjusted for their debt and use that for the theme parks. But Six Flags theme parks are very different than Disney theme parks, right? They're much closer. They have a much closer audience. There's not as much flying to them, a lot more driving. So that's the toughest part to me with bottom-up beta is finding a pure play. And that's a lot of what you do. You find pure play competitors so you can get their beta, or you do it subjectively the way we did it. The problem is you don't have the history. You can take the history of the beta of a pure play competitor and do that. Now, the me Walmart is a one product company anyway, so it almost doesn't matter. I don't know, you can definitely use that, but that's the bottom up. I don't like that here because you don't really know what they did to get this number. S27, there may be something in there. S27. So yeah, they do kind of give it here. Yeah, in this case, you got the unlevered beta for the firm, S21. Yeah, so if I were you on this beta, in fact, I would really almost require it. Plug in your own beta on the firm. So I'm going to use 0.6. And you can just plug over it. They don't have any kind of protection. So adjusted beta is just taking the 4% times that. Risk-free rate, we already did that. There's no size premium, so their cost of debt, their cost of equity is 7.3%. That's real similar to what I was using for Walmart, I believe. KE, yeah, I was using 6.6 to 7.6. So that's right in my range, which should be because I essentially forced it in there. And then adjusted for their cost of debt and the proportion and taxes, right? Taxes is all in there. So they get a WACC of 6.7. Why is it so high? Because they have a majority equity. Because you're definitely going to use the market value of equity. When you use the market value equity, if their price to book is like 3 to 1, equity is going to dominate this formula. And so that's the reason their WACC, you think a WACC of Walmart would be like 3%, 3.2%, but it's high because the majority of the firm is equity because of that weighted average. So you don't have to change much. So what did we change? We changed the discount rate. We changed the market risk premium by adding that to the discount rate. And I changed the beta. I'm not doing anything with debt. I don't recommend you do anything with debt. Just leave that as is. That's one thing we don't have time. I don't want to spend, it could take us 3 classes to talk about WACC. You had WACC, and that's one thing I didn't want to do. I didn't want to come in here and just say, you know how to do WACC, come up with it yourself. Because some people may not have had Catapacum's class. So just trust Capital IQ. They're pretty trustworthy on this kind of thing. So that gets you 6.7%. Then you come down to a forecast. So L69 is their growth rates. How did it get the growth rates? It's just the average. So here again, you could change some numbers here if you wanted to. Right? You have your own growth rates that you have from your paper 4. So you could certainly do that. You notice that it's all linked, but you don't have to have it all linked. You could change every year if you wanted to. This looks real similar to my forecast, doesn't it? They're just using the average of the last few years. So this is real similar to what I did. So you can change as many of these numbers as you want to change from your forecast. What they're giving you is the structure so that you can get to the valuation at the end, but you don't have to use their numbers. So getting back to free cash flow. So here's what do they mean by unlevered free cash flow? It's free cash flow before interest expense. That's all unlevered means. Free cash flow before interest expense. And again, Dante views this model. What are they going to do with that capital? I'm almost just curious just to see what they do with it, because it's a big number. And it is essentially is debt. And they give you that number here. Again, they're showing you the growth rates, which are very different than the past because of COVID, right? Because COVID caused a huge jump there. They give you some interesting information. Over here, they give you a CAGR. So one thing that looks really good in your paper, especially with a model like this, is to fancy it up a little bit and put these tables into the paper. Tables with a lot of data look really good in these kind of papers. It really impresses people. Sometimes you do it just to do it, just so it looks like you did a lot of work. It's that diligence, right? So it may not be great format here, but clean it up, make it look good, and put something like that in your paper. All right, so they do what is pretty standard. They forecast out 5 years. Pretty standard. I don't like that approach because if I'm doing alphabet, so remember this model. You got existing assets, you got growth, you got the steady state. Once you get out 5 years, they're assuming the firm's at a steady state. I don't think Alphabet's going to be at a steady state in 5 years. So if it's going to take Alphabet 10 years to get a steady state, you're going to have to do this model out 10 years. You can't just do it for 5. But I'm going to let you get away with just doing 5 years. But still, that's the thought process. You don't go out 5 years, you go out enough years so that you get to that terminal value, that steady state. Right, everybody with me so far? So we're going to value the firm off of these unlevered free cash flows. So here's your free cash flows. 15 billion, 15, 17, 18, 20, 20 billion. The discount factor is just taking, your discount rate and adjusting it. They're doing a half-year convention, which I guess is okay. That makes sense, right? So they're not raising year 2 to the second power, they're raising it to the 1.5 power. I like that approach. Because if you raise it to the second power, you assume all of their income comes right at the end of the year. And it's more likely to be spread out. Remember, we did that in my business finance class. All right, so that's fine. I'm not saying you got to check your formulas, just explain the formulas. So they're looking at where in the year, and this is pretty sophisticated here. They're looking at where in the year you are and they're adjusting it for that. So they're not even using half-year convention. They're saying, hey, we only have 0.27 left of the year to go. And then next year is, 1.27. So instead of two years, it's really 1.27 because we don't have that much of this year left to go. So I would just trust that they know what they're doing. And then they give you the present value. This year, they're just doing that last quarter. So here, they're summing up those present values. This is the end of this year. This is they say it's not actually 5 years, is it? It's only 4 years. And then the terminal value. All right, so let's look at the terminal value. So that's essentially what we're going to do is get the present value of those 5 years. And we're going to add to that the present value of the terminal value at the end of the 5 years. Why don't I like that approach? Do y'all notice any number that kind of dominates here? The terminal value. This is the Motorin's complaint. He asked his students, how many of y'all going to use discounted cash flow models? And 100% said yes. So that's great. They're doing what we're telling them. That's great. So then he said, I wonder if they really are. So he went out and quizzed them afterwards, 5 years later. And they all said, yeah, we're using discounted cash flows. And then he discovered they were all doing this. This isn't a discounted cash flow. It's a PE model because that's the majority of the value. It's this number right here. This is not a discounted cash flow. This is a discounted future PE model, but we'll look at what they're doing. So I don't like this. That's my main reason for not liking this approach. Now, if you actually went out with Alphabet like 10, 15 years until they got the steady state and then did this, I would think it would work. But I don't think it works the way they're doing it, just going out 5 years. Yeah, using some target PE ratio. So we're gonna have to see how they come up with the PE ratio. All right. So let's go to this. So it's P72, Q99. So P72 is probably gonna be that very last cash flow. P72. Well, it's EBITDA. It's EBITDA. So they can use an EBITDA multiple. So P72 is that factor 5 years out. Okay, comes what I say, Q99. So that's going to give you some kind of EBITDA factor. So I range valued it, but they're pulling that in. So this you're going to figure out in paper 7 is what is the normal kind of, here they're using, EV to EBITDA. What is that normal ratio? All right, so you'll figure that out in paper 7, you can just plug it in here. Now, let's say you have to use this model. This is one example of a model that they do. So 12.1, that's a really high EBITDA multiple. So I don't know if they give me any explanation here. 1 year, let's see. 1 year historical average. Please adjust as you see fit, all right? So in paper 7, we're gonna get what we call a target relative. Unfortunately, we're gonna do a target PE relative, and this is a target EBITDA relative. So we're gonna have to make some adjustment. We'll have to talk about how to do that math. How do you get from a target PE ratio relative EBITDA relatives are much, much lower than PE. So what I'm going to suggest is use historical relationships. That's going to make it easy. In paper 7, you'll have, we'll bring that data in, so it'll be pretty easy. So the PE ratio is normally 60% higher than the EBITDA ratio. So I'm just going to take my target PE ratio and divide it by 1.6, and that's going to give me my EBITDA ratio.
Is it higher because PE ratio?
Now we'll talk about it, but PE ratio is price to earnings per share. EBITDA ratio is enterprise value to EBITDA. Price is much lower than enterprise value because enterprise value includes debt. And earnings per share is much lower than EBITDA because it includes the subtraction for depreciation and interest. All right, so both of these numbers are lower. Both of these numbers are higher. So your EBITDA. Now, the Modern, he's a little bit cynical. Most people use EBITDA ratios. He says the reason is because people like to say EBITDA. They think it sounds cool to say EBITDA. I'm not quite in that camp. I think it's because people like to use lower relatives. Do you want to go to your boss and say, my target, the stock is trading at 32, or do you want to say it's trading at 17? You want your boss to buy the stock. You'd rather say it's trading at 32 or 17. Well, obviously 32 and 17 are the same. It's just using different numbers. But it sounds better to say they're trading at 17. Your boss goes, oh, 17, that doesn't sound that expensive. Why? Because your boss is thinking PE ratio and you're giving them an EBITDA ratio. I think that's the real reason people use. So I'm cynical too. I don't think it's because people like to say EBITDA, but we'll talk. We're going to do an entire presentation on relatives. So if you're not used to relatives, don't worry. We're going to go in detail on relatives. You're going to see it again, right? Some of you have already seen this presentation once, but you'll see it again. So 12.1, that's an awfully high EBITDA ratio for Walmart. But let's look at Walmart. It's under statistics. Even EBITDA. Did I get Walmart? Yeah, it did. Wow. Oh my word! These numbers don't look right at all. There's something wild going on in here. Well, their PE ratios over 30 as well. But yeah, there's something wrong with these numbers. Let me find a more normal company. Yeah, there's Yahoo Finance has some error in their model. That makes no sense. Enterprise value. Yeah, you can see that makes no sense, right? Because earnings per share has to be lower than EBITDA. And they're showing 119. I've seen this before at Yahoo Finance. They did it once with Beta where they were just pulling the wrong line. They had the wrong numbers, so there's no way that's correct. So I'm kind of shocked. But don't worry, on paper 7, when we do, I mean, when we do the model for 7, we're gonna be pulling the numbers from Bloomberg, not from Yahoo Finance. So you'd be fine. Wow, that's really bizarre. I've never seen that before. They don't show EBITDA in here. Financials. EBITDA is 130 billion. 130 billion. Or this is Apple. And enterprise value is 3 billion. Yeah, I can't see that. So 3,100 divided by 130. That's a 23. That's a normal EBITDA ratio. They're showing 119. So someone call Yahoo Finance, let them know they have another data breach. All right, so I don't know what their actual one is. I guess we could calculate Walmart's actual number. I switched to Apple here, but so their enterprise value is 483.64. And their EBITDA $30.089. It's 16 this last year. They say it's a 1-year historical average. I don't know what 1-year average means. They take 1 year and divide by 1. That's a pretty easy calculation to do. So I don't know exactly what they mean by that. But anyway, their current is 16, but we're going to talk when we do 7, we're going to come up with what we think the target should be. Not what it is currently, what we think long-term number is going to be. All right. So 12 seems high to me for Walmart. 16 is really high because Walmart's a little exaggerated right now. So what do? They take that EBITDA for that 5th year and multiply it by 12. I mean, it's real straightforward, right? 4 billion, 40, whatever it was. Line, well, I've already forgotten. Line 72. You're just taking that 44 billion times the 12. And then they're discounting it 5 years back. Real straightforward. That's all they're doing. It's this. Can you imagine? This is the standard investment bank model. It's really quite simple. So that's all that is. So they value Walmart at $471 billion. They're currently, well, was that the firm or the stock? So that's the other thing we're going to be careful of. So that's the enterprise value, 471. They're currently trading at 483. So they have them well back. They're within range. All right, I think y'all can handle a model like this. Actually, this actual model would not be a bad one. You can look at other ones if you like. You can see what you have to do to adjust. I've seen this one a lot, and it does work. Works well in interviews that you've done this one, so you can say you've used an actual and typical investment banker model. I think it's too simplistic for my views because it looks sophisticated because you have all these numbers, but when you look at a baseline, it doesn't make sense to me. You just go out 5 years like that. And then what did they do? They take out the debt. Now they took out minority interests. That's kind of helpful that they do that for me, so I don't have to go look for it. So you can definitely do that. And so when they do that, they get an equity value of 412, but that doesn't give you a stock price. So what they need to do then they take the number of shares and they get $153. The current price is 161. So you can update You can update these numbers in green or use capital IQ and it will update it automatically for you. The other thing you can do with this model, because remember we want ranges. The other thing you can do with this model is you could run it 3 times with your high and your base, best, and worst case scenarios, and get your values, and then you'd be set, right? Because what are you going to change? You're going to change the beta. You're going to change the growth rate. So you could put this in your football chart using this model. All right. I will. Now, how many of y'all? You've got capital IQ working. Who else is getting capital IQ working? You got it working on your machine. Oh, good. And you did. Okay, good. So I'll put. I think I can. You know, if I can't, y'all don't report me the standard reports, but I'll put this out on Canvas the way they have it here. I don't think there's any rules that tells me I can't say one of these. They know we're college campus. I don't know why the company name's not showing. So this is the one that's tied. I tried to copy his values. The problem when you copy and paste his values is the lookup bars get all out of whack. They go to the wrong places. So what I finally did was I just built everything and then I found all those capital IQ cells and valued them. It took me like 15 minutes to do it, but I also did the language one. So you can ignore the language one. Works pretty cool. I have to figure out that language thing because that's like, not that I need to do things in Spanish, but it'd be pretty cool, right? I could show Johan. You should see what Johan's doing. He's doing a bed and breakfast now. He's built the entire house. He's got a jacuzzi in the back. This 20-year-old kid out in the jungle is an entrepreneur like I've never seen. I mean, you saw his football field, right? I mean, just an incredible thing. But he could use a model like this. We could value his business using something like this. We'd have to get him a target EBITDA ratio. All right.
He was developing this project with, it was like 4 Airbnbs or something like that, with a pool.
He was, remember, you were there when he presented that to us. Yeah, he's just done one house. Luis moved and he bought his house, which I thought was terrible because that thing was like crumbling. And then I got a picture of it. He's redone the entire foundation. It's just, the kid is incredible. It's just amazing. Y'all need to go to Costa Rica with us next year and visit Johan, meet Bojan. All right. I recommend this model versus one I'm going to show you for paper 7, but if you want to do the one for paper 7, you can. It's similar, but the one I'll show you for 7 is much more simplified. But the nice thing about this is it's all set up and you're using WAC, and that's really what I'm supposed to do is have you have one model that uses WAC that you value the firm. They actually changed the title of this class for you to do that. So we're gonna do it so I can say we did it, so you at least get experience. I actually think it's actually quite valuable for you to see one of these because it is pretty standard, all right? And it's not that complicated, right? Y'all agree? It's just not that bad. Y'all can handle this. It's not gonna take a lot of time out, especially if you can get capital IQ to work. Now, if you don't have capital IQ to work, set up some time with me in the FSC. We'll get the one machine that is working. We'll get everything loaded in. All right, so let's look at the competitors. Let's see what y'all think about the competitors. Because there is another model in here. I can't remember where it is. Let's see if I can shrink this down some. Yeah, I saw it. Oh man, where did it go? Let me just search. There it is. Okay, where am I? I'm in column J. Okay. So they brought in Costco, Target, Amazon, Dollar General, BJ's, and Kroger's. I don't know how they do that. I should go back and look at the one that doesn't have it. They have something called, this is pretty incredible, IQ Quick Comp. That's pretty impressive. So that sounds like a pretty good list, doesn't it? It doesn't have Amazon. But well, it does have Amazon, excuse me. So not only do they have 6 competitors, but they have 6 very different competitors. They don't have Kohl's, but they have Target. They don't they have Amazon at the online. They have a Dollar General. That makes sense. You have one of those neighborhoods. They have a grocery store. They have BJ, so that covers the Sam's. They got Costco as well. I mean, that's a pretty impressive list. I'd be curious, now thinking about it, y'all are having trouble finding competitors. Maybe you need to just load this thing and see what comes up. I don't know if Juan Carlos, you can try that, see what it brings in. It'd be interesting to see.
One direct competitor with Joint Corey's flooring, and he doesn't show up. I mean, I just heard it on the podcast, but
It may not be publicly traded.
he just came out.
Oh, K1 Kappa Q. Okay, so you found this model then. You just clicked and found valuation models, right? Which one was it? What does it show? Can you remember what it showed?
Those are DCF, undervaluation.
From the valuation.
Okay, I can't remember where I picked it in the list, but I'll save this actual file out there so you have it. So that's pretty cool. They bring in their betas. I wouldn't think Target be above 1. Their debt, their market value. So they're bringing some data on them. What is interesting here is they will have a relative value model as well, which is something you might want to even add into your paper 7. I'm not saying you have to, but if you just want to get more sophisticated. So what you'll see in a lot of these models is they'll bring in competitors and bring in their PE ratio or EBITDA and adjust it for debt or something to try to get it equalized. And that gives you that target number you're looking for. So there's another Capital IQ model that will actually do that for you. But it's pretty cool that they bring in such an impressive list of competitors. So how many did you have? Did you bring in 6 as well?
Yeah.
Did you bring in Home Depot and Lowe's? And the LA one, anybody else that you haven't heard of?
Yeah. Number liquidators.
Yeah, I mean, that's impressive, right? I don't know how the computer does that unless somehow someone with every company put a list with them or something. I don't know. It's not obvious who your competitors are. This is pretty powerful to do like a Disney. So y'all might all try this and see if there's a competitor you're missing that you need to have on your list, because that's pretty impressive. All right, so I'll save this file out there. I'll put it under files for papers, and I'll have paper 7 Capital IQ valuation model, something like that, so you can find it. I'll only give you the ones with the formulas, because if I give you the Walmart one, it won't work for your company anyway, since none of y'all doing Walmart. All right, very impressive. I've been really blown away with Capital IQ. There's a whole lot more with Capital IQ than what this is. I mean, it's just amazing what they do. So another big advantage of this is so you can put more on your resume that you're using Capital IQ and seeing some of the things that they have. So even just in an interview, just saying, yeah, I have this valuation class, and using Capital IQ, I use some of their investment banking models, really good models. It just sounds impressive that you know how to use these databases. You know where they are, what they have. If you're entering a firm that uses Capital IQ, it's going to be really important. If you're interviewing with a firm that doesn't use Capital IQ, it can be even more impressive. Just to say, about stuff that they're not using, and you can bring that into the firm. That's one of the reasons they like hiring college students, is you have that ability. All right, so you can run this multiple times. It gives you a valuation. So what else can I run? Well, let me say the beta is 0.7. And let me change my growth rate to 3.4. When I do that, what valuation do I get? I get 143. So it went from being well valued to being undervalued. So you can see it took me 5 seconds to do it. So you can run multiple models, get your football chart. So what would you call this model? Do they have a title for it? Again, what did they just call it a dividend discount model? Or something? DCF, yeah, so it's not a DCF model, it's a relative value model, but they call it DCF. So this is kind of the argument the motor end makes. This is not a DCF model, this is a relative value model because the majority of the value is coming from a relative value model. So you can't call it DCF if 90% of your market value is coming from that. So you can run scenarios to save, maybe save each one as a separate file and you have your values. So so what they, I don't call it that. So I would call it a oh, maybe investment banking free cash flow model, or just make it sound something really sophisticated. All right. Y'all can see why I'm going to put this in paper 7 and not in paper 6, because it is not a different, it's not a discounted cash flow model. It is a relative value. So that's why it belongs there. So this is more paper 7 than 6, but it's using some of the concepts we were talking about on 6. It does have discount rates because you're using the discount rate for that terminal value, but it's a relative value terminal value. All right, any questions on any of that? All right, so I'm sorry?
This model, then you have a different page.
This is gonna be in paper 7. So paper 7, you're gonna do a screening model, similar to what we do in the investment society. We'll show you that. We'll do that in the FSC. Hopefully we can get that done in 40 minutes. And if you want to, you can watch videos in advance, get a head start, or even do it all on your own. So we'll set up, I'll be scheduling that this next week, and I mean, we'll do the schedule, the coordination next week, and then have it the week after that. So that next week. That's a screening model, but it's a screening model that's heavily focused on relative value. And so that's why this model fits better in paper 7 than in 6. We'll pull in the entire sector, maybe not. It kind of depends on your company. So like we'll pull in all consumer discretionary for your company. For yours, we might just do restaurants. So it kind of depends. We can't do yours because there's not enough companies. So we got to broaden it out. We might kick out some firms that just don't fit well, but that's the kind of thing. But you can do all restaurants and you have enough restaurants for it to work. I saw one model where they only did airlines and it worked really, really well, even though it was only 13 companies. So it just depends. We'll have to experiment some, but we need a larger group of companies.
That was my question. Like I was going to ask, whenever we are going to be
FSC.
we're gonna do every single company.
If we're going to break it out to just bring in the sector. But we'll look at the sector and see if there's aren't a few sub-industries you may want to kick out. But a good example is healthcare. So Luis is just going to do pharmaceuticals. He's not going to do all of healthcare. If I were to do Medtronic, I would probably just do healthcare equipment.
In my case, then
I might do all industrials for your case. We'll see. If there's 40 transportation companies, maybe we'll just do transfer. That's part of what we got to do. So we got to look, and that'd be a good thing to check in advance, kind of see. So you want to try to get at least 40, 50 companies if you can. Now you can go back and look at the list you did for paper 3. That might work. If it's only 10 companies, it's probably not going to work well. The airlines worked because airlines is so specific. And you have some really, really good industry specific numbers. But usually 10 to 15 is not enough. You want a lot more than that. So you can look at paper 3, that could be your starting point. If you've got 50 companies in paper 3, like I did for Walmart, I probably could just do that. But for Walmart, I would just use consumer staples.
yeah, like in my paper, we use the terms. Remember that?
Yeah, that's fine. So, but you might even broaden it out to industrials. Well, you know, we're not going to be overly precise because a lot of it's just practicing, getting used to building the model and then commenting on it. So it may not be ideal what we're going to do, but you'll have something so you can good practice. And then on the job, when you get your actual job, you can say, I can refine this better because I'm working here 50 hours a week. This isn't a college class. You'll have more time. All right, so watch the email and then we'll definitely next Tuesday and Thursday solidify that schedule so we know exactly who's coming when. And everybody knows, so we'll have a walk the Tuesday after next. And we'll be doing 3 sessions in the FSC instead. All right, everybody's kind of got the schedule down, all right? So this essentially gives you, so paper 7 is the screening model we'll do. It's gonna be a model like this, if not exactly this model. And then you're gonna put your football chart in there, which the football chart is paper 6 and 7. All right, you'll see where we're going. It's not as complicated. Everything looks overwhelming, but once you get papers 1 and 2 done, it really moves a lot faster. All right. Stop it there. I think I'll save this because I don't remember what I did, and I'll put this paper out there. So this is file, when you load it, it's going to have all these error messages in it. So